GDX provides great examples of chart patterns being universal across markets, since it is an ETF that is heavily influenced by factors from the commodity futures market, mostly involving gold. There is also influence from the stock market. Regardless of the market or merging of market influences, there is familiar chart activity in the form of gaps, double tops, and triple bottoms that are mainly small reversals in a larger downtrend. From April to June, there was a great example of a failed double bottom, with a slight decline. When this lower boundary was breached, it was essentially the completion of large-scale 3 methods falling price action in a bearish continuation. Since the resting phase had that declined angle, long-term bearish sentiment is strong, especially as there were the characteristic bearish spikes before and after this relatively low volume period. Short-term downward overextension leads to major volatility as a sharp reversal begins with an inclined double bottom and ending with a double or triple top range, depending on how the exact downswing points are counted, based on closing and or high prices. There are features of general head and shoulders price action and the distinct break of an inclined neckline that even sees a bearish spike to end September. However, this is a less strict head and shoulders due to the more extreme proportions and relatively small uptrend prior to its formation. The later part of 2014 was a great example of bullish volatility, as there were major price fluctuations in a short-lived uptrend. Normally, volatility is associated with bearish price action. However, it simply refers to sharp changes in price over a short time. As seen in many other examples, there can often be major price fluctuations with bullish spikes prior to the progression of a large downtrend. A bullish range from 2015 to 2016 is an overall horizontal range to form a flat bottom rather than a double or triple bottom. Resistance is still encountered from the long-term downtrend line, with residual influence to even reverse rolls and precisely contact the sharp upswing at the end of 2016. Importantly, this took place after price fell from the more significant resistance at the old 25 to 30 range that was mainly defined by earlier patterns. At first, it seems the late 2016 uptrend just moves into a horizontal range at firm resistance at the old 25 level. However, it gradually becomes clear with sharp downswings and bearish volume spikes that it is essentially a long resting phase in a bearish continuation that is accelerated by a descending triangle. This descending triangle is successful but takes place in more of a range-bound context after an uptrend, rather than taking place directly within a stable downtrend. Descending triangle, providing normal heavy resistance upon contact from the more recent uptrend. Eventually, resistance from the 20 boundary near the descending triangle's base drastically dissipates, as seen by much lower red volume and only a minor downswing into the start of 2019. This again shows even a large-scale pattern doesn't offer guaranteed resistance forever. The large uptrend that followed was also helped by long-term bearish sentiment subsiding after almost a decade-long slide. These technicals reflect major fundamental factors changing in the stock market and commodity futures markets at the end of the 2010s. From a more medium-term perspective, there was also short-term overselling after breaking the descending triangle's base. As well, there was also a reverse head and shoulders that could have been difficult to spot for some due to the slanted neckline range, and shoulders that had 2 small upswings instead of the usual 1 upswing per shoulder. However, experience with trend lines provides an advantage in cases like this. This relatively small pattern had a great impact due to the clear shift in diminished bearish volume to the sustained period of moderate bullish spikes during the formation of the reverse head and shoulders and the weeks that followed its completion.